Q3 earnings are out for PepsiCo, ticker symbol PEP. So let's do a top-down analysis. We are now sitting at a market cap of $233 billion, a PE of 25, and a dividend yield of 2.7%. And actually, if we take a look at the food and beverage sector as a whole, it has actually held up really well despite the rising rate of input cost inflation, which has impacted fundamentals across the sector and even caused PepsiCo to start accessing debt to reward shareholders, which we will get into in just a little bit. On the other hand, they've made some acquisitions, raised organic sales guidance recently, but is all of that enough of a catalyst to interest investors and send the stock higher? Stick around to find out as we talk about that and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today, we are going to analyze Pepsi's business and earnings results. We'll start with a full analysis into the financials. We'll go through the top line, bottom line, balance sheet, cash flows, etc. And then finally, what we'll do is we'll conclude with an evaluation of this business using our intrinsic value calculator seen on screen, which will identify whether or not Pepsi is a value investment opportunity or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. As always, we will be doing this analysis in 5 minutes. So let's jump into it. All right. So as always, we will start with the CEO's comments here for this earnings release. And as you can see, they're pleased with the results recently as their global business momentum remains strong. They have once again increased revenue estimates for the end of the year to now 12%. And they have also increased their earnings per share guidance as well. Essentially, they're happy with the results that they've seen so far. And they're saying this is a result of their PEP Plus strategy working and that they remain committed to investing in their people, brands, and supply chain, etc., which has been the result of their success so far. As you can see below here, we have had revenue increasing year over year of late. That is always a great thing to see, but unfortunately, bottom line has not been of the same consistency. It's actually been relatively flat here for the most part. We will get into the margins, all of that as well. I want to talk to you again about this debt figures here. As you can see, their debt has been increasing while their cash has been increasing. Again, we will get into that as well. Just in case you weren't familiar with PepsiCo's business, here are some of the most reputable brands that they do own, and their revenue mix actually comes from a majority of convenient foods. Only 45% of it is attributable to beverages, in case you didn't know. They also have about a 19% market share currently, so they are one of the leaders there in this industry, Walmart being one of their main partners. And in case you're not familiar with PEP Plus either, essentially what it is a strategic transformation here of this business. They are trying to achieve net zero emissions by 2040, and ultimately the goal is to become more sustainable, and they will be doing this by working with businesses like Tesla, who will begin to deliver their semi trucks in December, so that'll be interesting to see as well. Now let's jump into the financials here, and we'll start with our net revenues here, which came in at about 21.9 billion for this quarter. In order to produce those revenues, it cost them about 10.3 billion, so they're left with about 11.6 billion in gross profit. We deduct for our SG&A expenses, and we're left with 3.3 billion dollars in operating profit. Okay, this translates to $1.95 in earnings per share. Keep that figure in mind when we get to the end of the video with our estimations. And I just want to point out that they're keeping their gross margins here at around 53%. Although they have been declining recently, they are still maintaining that ratio. Now let's jump into our balance sheet here. We can see they have $6.4 billion in cash, 300 million in short-term investments. We can equate that to being about 6.7 billion on the balance sheet. We compare that to our debt figures here of 3 billion in short-term debt plus $36 billion in long-term debt obligations. So they have about $39 billion in debt on the $6.7 billion in cash. That doesn't look amazing. However, this is a business with about $94 billion in assets. However, majority of the assets here are actually intangibles. So that's also not something that we want to see. Balance sheet doesn't look as good as you'd want it to, especially not from a value investing opportunity, but it is not the worst thing I've ever seen. They're just, in my opinion, slightly over levered, and their cash position has been decreasing over the past few years while their debt position has been growing. And so when we look at this from a 9 months perspective here, and we take a look at their statement of cash flows, we start with about $8.4 billion in net income, deduct our non-cash costs, and we're left with $6.3 billion in operating cash flow, deduct our capex figure here of $2.5 billion. So we are left with about $3.8 billion in free cash flows to reward shareholders. How exactly do they do that? Well, because they are committed to continuously increasing their dividend growth history, that means they need to take on more debt in order to service that dividend, as the bottom line has not been translating well through the balance sheet and into the free cash flow statement. So they're taking on some more debt, although they are paying off their old debt. And then again, yes, paying down a dividend and repurchasing shares while the shares are historically low. All right, so before we jump into our calculator, let's actually take a look at the average annual earnings estimates. Wall Street believes that by the end of the year, they'll have about $6.70 to $6.75 in earnings per share. Actually, when we look at this from a 9 months perspective, we're actually at $6.04 so far. So based on those numbers, I'm going to estimate here that we can actually come in with about $7.50 by the end of the year in terms of earnings per share. We do require a 10% return. They are paying a dividend. And so if we expect that this business can grow at 5% as they have been for the past 5 years, going forward, and then that drops down to 3 years for the 5 to 10 years after that. On a 20 PE, we can anticipate that a fair price for Pepsi would be about $150 per share. They are currently trading at about $170 per share. All right. In an optimistic scenario, they have alluded to growing at about 10% for at least this next year. So if we assume that they can do that for the next 10 years on a 25 PE, the stock would be worth about $263 per share. Now that is some significant upside from where we are right now. However, I do not believe Pepsi would be able to grow at 10% for the next 10 years. I think it'll actually be more realistic if they can grow at, maybe 7% for the 5 years after that. That still puts us at a price of about $240 per share. Now, in the very worst case scenario, in our margin of safety estimation here, if Pepsi cannot grow for the next 5 years and then actually starts to decline on earnings and bottom line by 3% for the next 5 to 10 years, on a 15 PE, the stock would actually be worth about $87 per share. This is, again, the very worst case scenario, and in many ways a little too pessimistic, but their issue right now is the amount of debt that they have on the balance sheet. They have been using that debt to pay out and reward their shareholders, which is not something I am a fan of. And so despite their 20% market share, it's something I'm going to stay away from for the time being, at least. And although this is a business that has been compounding year over year over year, I will be staying away at least for the foreseeable future, as we did actually trade near those margin of safety levels way back here when we had our initial 2020 market crash. So unless we do get down there, I'm not so interested in picking up shares of Pepsi. That is the analysis for PepsiCo's business and earnings results. If you enjoyed the analysis, please leave a like and subscribe, and I'll catch you on the next one.